so we're going to go ahead and get started. And we're going to open it up first with a general question to the overall panel. So to Finley, Sarah, and Greg, if you can weigh in this one. So obviously this year is easily on track to be the highest biotech IPO number in 5 years and total record valuations. How do you anticipate that to continue or not potentially post 2020 into 2021? So Greg, maybe we'll start with you.
Sure. Can everybody hear me? Yep. Okay, great. So yeah, it's been amazing. I think it will continue unabated. And the reason I think so is infectious disease has never been as much in the forefront as it is right now. As a result, you've seen a huge public interest in getting to know what these companies are all about. It's obviously starting with COVID, since that's the headline grabber, and that both encompasses prevention as well as treatment. But way beyond that, it's now gone to diagnostics, biotech, and vaccine outside of COVID. And these things tend to go in waves. And part of the structural issue is that you have healthcare dedicated investment funds. They've always been around. They're seeing massive inflows, so they have to do more investing in the sector. But you're also seeing generalists looking for return in the market. And there tend to be a lot of crowd followers, and these trends tend to go on a little longer than you think. So for me, it's real simple supply and demand, coupled with the fact that infectious disease is going to stay in the news. I mean, we're going, to hopefully get vaccines, and then we're going to get rollout plans, and then we're going to find that not everybody's getting vaccinated, and on and on and on and on. So my answer is yes. And overall, from a stock market perspective, the number one determinant of whether people are willing to take more risk and invest in earlier stage companies, such as IPOs or SPAC mergers or whatever it is, has to do with interest rates. And it's very likely that the Federal Reserve and central banks around the world are going to keep interest rates extremely low as the economies try to rebound, throughout next year. So when you put those two things together, it'll be volatile like it's been this year. But yes, I expect it to be very robust throughout 2021.
Thanks, Greg. It's certainly, interesting for the infectious disease space, as you mentioned, really once I would say forgotten space and not very loved from a capital flow perspective. So it's interesting to see from a population health standpoint where we are at in terms of its impact, but much needed for capital flows. Finley, I'm going to turn it over to you to weigh in on kind of market trends that you're seeing.
Yeah, I agree with what Greg shared. I'll also add a couple additional thoughts there. Is all the rules that I used to know around helping companies go public, all of those have been broken here really over the last, certainly this year, maybe over the last 12, 24 months. And a couple of those things as we think about that is, one is, companies are going public earlier and earlier. And some of those things those market factors that Greg just mentioned, infectious disease, as well as just the amount of capital on the sidelines and looking for a place to put that. And so, where the competing space typically been is in tech, right? And so what we're seeing is some shift as we think about where those dollars go. And to Greg's point is there is followers that are putting their money in that life sciences space. But as part of that is really, one is, in light of the pandemic, a lot of investors, both, at all levels are thinking, okay, well, what do I want to invest in? And I think certainly this pandemic has given everybody across the world an opportunity to reflect on that. And so we're looking at a number of investors that may bring a different light to investing than they did even 12 months ago, realizing that we're still in the first 12 months of all of this, right? So that's one piece. The other thing I was going to mention is just in terms of this is all different and in many ways breaks the mold of what we've been taught or what we've learned over the last 20 plus years. Sarah, myself, Greg, having done this, is typically companies never went public in an election year, and if they did, it certainly wasn't in the second half of the year. when I think about what we're seeing, and we're helping companies go public all the time. I had a client file its S1 publicly last week. Sometimes it's a reverse merger, sometimes it's a SPAC, whatever it may be. But part of that is you'd never see anything in an election year, or presidential election year. You'd never see anything in the second half of the presidential election year. And both of those things have been broken. So if we think about what this year looks like, Q1, there was activity. Q2, everybody hit the pause button. Q3, which again, it's an election year, plus additionally, then all the bankers also historically go on vacation in September or August. There were still IPOs going on in August. Again, kind of broke the mold. And I think as part of that, I would agree with Greg that we're going to continue to see this go on into next year for some of those reasons he mentioned. But what's interesting is that we've got companies, I've got clients who've gone public this quarter, that are planning to go public through the end of the year. And so it's really an interesting place to be. What I've heard from the investment bankers, and I'm not an investment banker, I'm a CPA, is basically that the market was able to price in a certain component of the uncertainty around the election into what it had done. And so as part of that is that people are feeling fairly comfortable, and certainly has resulted in Biden and Trump being the nominees, that basically the market had adjusted that in. The other piece I was going to say to that is it also then raises the concept, or at least I shouldn't say concept, it raises the opportunity for SPACs to be in play. And so last year was a high water mark for SPACs, and this year blows it out of the water, right? So as we think about that, one of those things, and one of the things that's advantageous under a SPAC would actually be that concept of actually negotiating the deal terms and removing some of that market volatility. And so that's one of those key things as you think about this, and I know everybody brings some different experience, but one of the things, if you're thinking about that SPAC, or you're saying, why are there so many of those, is it because it removes some of that market volatility? Again, it's a negotiated deal. And so that's a very interesting concept. It used to be that SPAC was not looked at with the same, was not looked at in the same way as an IPO through an S1. And so, it was the unloved child for a number of years. And really that stigma is been lifted. So again, just some things to think about, but I would say that this is going to continue. I've got clients that we're actively engaged with, life sciences companies that have IPOs planned this quarter, next quarter, the following quarter, out into 22, 23. And some of you mentioned that. So again, I imagine that continue to go on.
Great. Thanks, Finley. Sarah, anything you'd add from the audit side that you're seeing in terms of?
I agree with
cycles?
Both Finley and Greg. I don't want to repeat what they've said, but definitely more money is flowing into biotech. Money's cheap right now. VCs are able to raise more funds. They want to see exits. Biotech investing generally, cyclical, but the IPO market is currently still strong. On the other hand, if companies aren't able to generate good clinical data because of delays, uncertainties due to COVID or otherwise, that could have a knock-on effect on future IPOs. But right now, I would expect IPO market to be strong.
Great, thanks, Sarah.
Great, I'll take maybe the second question here for the group. So, I think there are a number of folks here on the phone that, are thinking about going IPO maybe in a year, in 2 or more. The road to getting there may take, a little bit of time, obviously, and to sort of prepare and be ready for that. So perhaps maybe back to you, Greg, if you can share with us some of the best practices that you've seen kind of leading up the organization to that milestone, and some of the work that has to be done or has to be put into place, prior to that.
Sure, just want to unmute. I'm going to take this question, I'm going to leave it to Finley and Sarah to talk a little more about sort of the nuts and bolts side of this, from, some of the things you have to do to prepare from an accounting perspective or whatever. But I take it up more from a management experience view. And one of the things is that the whole organization has to be focused on it. Not only on the execution of the transaction, but really what life looks like after. An IPO is not an exit. It is the beginning of a long process. And that process is now, you live with the light shined on you like nothing you ever had as a private company. And there's a clock ticking with the SEC. Like if you're a private company and your VCs have invested and there's a term in their preferred stock agreement that says after 180 days, you have to let them know what the results are, and it slips 2 months, nobody cares as long as the business is on track. The SEC, not at all like that. Every 4 times a year, you've got to make filings with your financial results. You've got to put out proxy statements. You've got to put out timely information on 8Ks as soon as you make announcements. And it's just a much different pace of existence separate from your sales and marketing organization or your R&D group. So one of the things that is really key to that, in my mind, is cross-functional cooperation. You have to have that in any company that's growing, but you have to stress it in an environment, in my mind, where the spotlight is shining. I actually am a big fan of using a software package, something like Asana. I don't know if people do use that, but something that actually you can put in your organization to not just say, oh yeah, we have cross-functional cooperation, we have a meeting each week, but something where you're actually capturing all the things that have to be done by the organization with accountability that you can follow up afterwards. And I'm sure there's a lot of different software packages out there. Like I said, I'm just used to working with, this one, Asana. Another thing that I would say, and this is apropos, to our friends from Carta here on the call, and full disclosure, I am a Carta customer right now at one of my companies. Your cap table has to be squeaky clean. Like there is no, oh yeah, I missed that. Like the underwriters won't take you public, and their underwriter counsel will not sign off on the deal if there's any doubt about the cap table. That's one of the major risks to an underwriter that they're worried about, because in an underwriting and an IPO, they're not selling your stock to the public. They're buying your stock and reselling it to the public. So it only takes about 10 seconds or less when that happens, but that's where all their liability comes from. So if somebody shows up and says, hey, I own 2 million shares of this stock and I have a certificate to prove it, and it's not in your cap table, that's a huge problem. So you have to get on your cap table early. You have to use a software program. You cannot manage it in an Excel spreadsheet. You're going to have to use it through the underwriting process. You're going to have to refer to it if you do a crossover round. You're going to have to use it if you're doing a SPAC. And you're going to have your board of directors, which is the next thing I'm going to focus on, get familiar with that cap table, and both your audit committee and your comp committee chair people be able to sign off on that. So you've got to create a lot of certainty there. And that board has got to look different. It cannot look like what your venture board looks like. You need independent experts. You need diversity represented if you're in the state of California, which a number of people here have mentioned they are. And you need real expertise. Never mind just filling the boxes. Like I said, I've been doing this for a long time. My 25 years as an investment banker, I took a lot of company public. I've served on 3 public company boards. I view my partner as the head of the audit committee and the head of the compensation committee, and not just someone who can say, oh, okay, I read this and I'll sign off on it, but somebody that can actually help participate. So, you don't want to add that person the month before you go public, right? You want to get that in place ahead of time. You have to pay these people, which is different than private company boards, because private company boards are either usually members of the management team or members of the investment group. So that's just sort of another thing to think about. And the final thing I'll leave it with is, from an organizational perspective, a lot of companies have either subscribed to sort of a lean startup approach to running businesses, or you just, when you're looking at your limited dollars and you want to stretch them as far as possible, you tend to invest in your product and your sales. And it makes a ton of sense. It's the right way to do things. You cannot underinvest in your administration functions as you're getting ready to go public. If you are bringing in someone to head your finance group and they tell you, I need 5 people to get this done. They need 5 people to get it done. It's not a negotiation where they say 5, but you can get away with 3. You cannot shortchange this, because again, there's a ton of work to go into getting public, either through a traditional IPO or a SPAC. It's actually worse in the case of a SPAC because the whole process goes a lot faster, and all of a sudden you're public, and you've got to make your filing deadlines. On the HR side, again, full disclosure, I'm a Trinet client. I actually brought them into my company that's getting ready to go public. That is a great way to address the issue. Guaranteed you've been underinvested in HR as a company about to be public. Again, you may have been doing it perfectly well from a private company's perspective. The fastest way I can think of to get up to speed is to bring in a PEO and let your head of HR leverage them so that your head of HR can stay strategic. Because I haven't met a company yet who's on the verge of going public who isn't going to double their workforce over the next 12 months. And to do that, you've really got to focus on who you're going to hire and what they're going to do and how many options you need and everything else. And you'll get off the tracks quickly if you're forgetting your state tax filings, if you're not getting your 401k done correctly. And I've always used Trinet. There's others out there, so I don't want it to be just an ad for Trinet, but you need this partnership. You have to leverage your organization on the admin side. I'll turn it over.
Awesome. Thank you, Greg.
Perfect.
Really great advice. So Finley, yeah, I'll go to you next. What kind of advice or best practices can you share with the team here as they think about IPO readiness?
Yeah, I got a lot of thoughts on this, and one thing I'll just echo, and because Greg said it really, really well, the IPO is not an exit. You're not done. If you think about the analogy of a running race, a foot running race, right? When you run through the tape, a lot of people go, "Oh, I ran through the tape, I'm done," right? I got there, right? That's going public, and that IPO that's just the beginning of the race, right? And so as you think about it, in some ways, the IPO and more so with the SPAC is a sprint, but you're running a marathon. And so as part of that, and unfortunately, the end of the marathon never quite it keeps getting pushed out as long as you're public. I think Howard said that earlier. You're not sure how many innings this is. And so as part of that, as we think about really what that IPO looks like, the way we as a firm approach this on the advisory side when we're helping companies go through an IPO is really thinking about 3 phases, kind of the pre-public, kind of the planning piece of getting the right team on board. And so some of that is just getting the right advisors, like Greg had mentioned, including, SEC counsel, such a critical component to getting that done, as well as the board. And what I'd say is you can't start early enough on some of these things. But anyways, you got kind of that planning piece, and then you've got the actual IPO activity. So it's everything from launching with an IPO readiness assessment, kind of where you are now, where you need to be. That's what we'd recommend up front. There's a recent study that said 83% of companies had a readiness assessment done. And I would just say that's the most important thing because it really provides a roadmap. And a lot of times we're working with companies very early in the process as they go through that kind of planning stage, and they go, "We're not quite sure. It kind of looks like this, but we're not sure about." And as part of that is providing some definition, and even if it is picking a date, realizing that the date, whatever date you pick, is not going to be quite right. Heard that one of you is pregnant, right? We couldn't guess the exact date that you're going to have your daughter, your beautiful daughter, but as part of that, at least getting something down on paper. So I was meeting with a client last week, and we just said, "Hey, we're gonna plan towards its Q3 of next summer. Could we move it to Q2? Certainly, if they get some positive data. Might that shift back? If enrollment's a little bit slower in their trials, might that shift back to Q4? Yeah, certainly, but at least picking a date and going through there. So from that perspective, we really think of it in those 3 tranches of kind of that planning piece, and then it's really around the whole IPO. And then from there, it's the post-IPO of really developing those patterns and the rhythms of becoming a public company and really maturing the organization. And so within those 3 things, within kind of those 3 phases, if you will, there's really 3 considerations that we come back to time and time again. It's one, it's the people. So who do you have on your team? That's both employees, consultants, advisors, attorneys, auditors, insurance as an example. I was just talking to somebody recently. They go, "Boy, D&O insurance says we're not taking you public, go find another one, right? So all of those groups, but really that people is the first thing. And to Greg's point is so much as a VC-backed, sometimes angel-backed, but early-stage company, any dollar you spend on people that aren't doing the science is taking away from that, right? But at some point, you need to make that pivot, and that's why some of those things around just leadership, board composition, and the senior execs is so important to make sure that you've got those people who can provide that vision towards what it looks like and know when to really hire up. So that's the first thing is people. Second one is those processes. So how do things actually work within the organization? So if you think about going public, certainly clinical trial accruals is going to be critically important, and your auditors are going to have to get comfortable with that, not just from the standpoint of what ends up on the balance sheet, but then also that's going to link back into all those other elements that you really want to go and have a message around when you're raising money, right? So as you think about that, a key piece of that is the message, and having good sound processes will actually be able to enable you to be able to share that message. So again, coming back to working with investment bankers and having that message and having some clarity of that. I've had some clients where the banker said, well, what are you? Are you a diagnostic company? Are you who are you? And sometimes some of our clients kind of have this kind of ADD of who are they, because they're trying to do too many things, but coming down to a really distilled message. So that's the second piece, is those processes. Part of that, and I would echo what Greg said, is getting the cap table right, as well as any of those early stage debt and equity pieces, all the agreements that are up front, making sure that all that stuff, this kind of legacy stuff, is perfect. It's all dialed, it's set. So you've got the records, you have a contract management system, so you actually know where these things are. As you go through diligence, someone can say, where is this? And you go, I don't know, it's in some guy's desk drawer somewhere, but he's gone. He's in Spain for 3 months, right? So all of those things, you think about kind of the processes. And then the last thing is systems, considering when to implement different systems. And one of those key ones would be obviously the ERP or the general ledger. And as part of that is a lot of our clients, they're using QuickBooks, and they got accounting staff of 3 people, and then they go, we want to go public, and we go, on QuickBooks or something else? Well, we're not sure. When could we squeeze in a NetSuite? Well, squeezing in is a good way to describe it. It's also very, very painful. And so as part of that is, what does that look like? When to invest in systems? And I think to Greg's point is outsourcing where possible to a SaaS-based, obviously this is 2020, and into a SaaS-based tool, whether it be a SaaS-based ERP, whether it be looking at some of the other tools, Carta and Trinet among them, right? And so looking at those both providers and tools that could help with that, or say like an Expensify or Coupa or some of these things, is you just think about how do you process all this information and how do you get good data? And it's so funny because a lot of times when we're working with life sciences companies, they're so focused on clinical data, and they've got that dialed. But then as you think about the relating accounting data coming from systems, that's where we go, how does this work? Well, we have this, we're on our 3rd CRO amendment like this week. Well, how do you have, what's the clinical trial? Or what's the accrual? Well, how many people enrolled? Well, we had to add more sites to get the enrollment up. Okay, well, where's that? How much is that going to cost, right? And so as part of that is life sciences companies are so focused on data, but that data tends to be focused really just in that sphere of clinical. And so as part of that is utilizing some systems that actually help and facilitate your ability to go public, be able to pull information. As we think about, and Greg mentioned, if going through a SPAC, it's quick. It's quicker than an IPO, quicker than an S1 IPO. And as part of that is what's funny on some of this, and I'll end with this point, is a lot of times when companies are looking to go public, they'll draft an S1, and it's hard. Not taking anything away from that. It's hard. It's the first time you've ever written this for your company, right? And doing all this, but you have time, and then you kick it over to the SEC, file confidentially. You get some more time. You get a month. They respond. Then you get 2 weeks to reply, and back and forth. And you do the dance. Aside from updating those data, those numbers which go stale in 135 days. Aside from that update, you get a long time. And if you think about it, the 135 days is forever. Right? Versus the thing that's scary, and this is why we always say that the IPO is really the beginning, not the end, is when you think about that, going public, and then from there having the people, the processes, and the systems to be able to timely report on a quarterly basis, And those Qs are harder than the 10K in many instances, because you only have 40-ish days to get this done, right? Depending on the number of factors, right? But if you only have 40 days to get a Q out, that's rough. You got to close, prepare the document, get the auditors through it, get everybody else through it, get the attorneys to give risk factors, which they're always shuffling, right? And all those things, and then press go. So again, that's one of those things that we'd encourage you to think about, is kind of the planning, then the actual IPO process, which is preparing the S1, doing public company audits, all those great things. Sometimes it's getting the valuations in, which Carta can do for you, right? But getting the valuation, make sure all those things are addressed, the technical accounting pieces, and then getting into just the maturity of being a regular public company and getting in those patterns and rhythms. So again, that's kind of those three things, and then the people, the process, and the systems.
That's great. Thank you, Finley and Greg. Greg, we're going to come to you on the next question. So for financing pre-IPO, what should companies consider in working with crossovers and other players really on that kind of mezz pipe round just beforehand?
Sure. And just to make sure, does everybody know what a crossover investment round is?
I think we could give a good primer on that, Greg.
Okay.
Yeah, would be
I'll
great.
just give, for 2 seconds, the crossover means crossing over between a private round and a public round. So there are a certain group of investors, venture capitalists, who only invest in private companies. There's a much bigger group of investors who only invest in publicly traded companies. Those typically are mutual funds, and mutual funds have basically taken over the industry. But there are a group of investors that are comfortable buying securities privately and then owning them through the company going public. The VCs will typically try to sell their stock, 180 days after a company goes public. But there are groups of investors who like to buy on the last private round before a company goes public, and then will buy again on the IPO, and maybe even buy again after the company is public. And those are the crossover investors. It used to be, it was a very, very small group of investors, and it wasn't necessary to do a crossover round before going public. What I'm seeing in the life science sector, which seems like pretty much what everybody on this phone call is involved in, is there are very few investment banks that will take you public through a traditional IPO without you doing a crossover round. And the reason they want to see that is the crossover rounds are usually your biggest private round. They want to see that you're able to attract sort of the cognoscenti of the life science space, because it is so specialized, and that those people are willing to put in big bets before you go public. And just as importantly, they will usually put a multiple of what they put in the private round into the IPO. So if you get a major life science investor who's known for investing in lots of biotech companies, put 10 million into your crossover round, the assumption is, it's not a contractual thing, the assumption is they'll put 10 to 20 to $30 million into your IPO. If you're able to attract 3 or 4 private investors in your crossover round that sum total up to 30 to 50 million, and you're thinking of doing a $100 million IPO, you pretty much have $100 million of demand on your IPO before you start marketing your deal outside of that group of people. And so the underwriters want to feel comfortable that you wouldn't necessarily price an IPO if you only had $100 million of demand for a $100 million offering, but having that $100 million before you even go out to market. And better yet, if the crossover investors are comfortable letting the underwriters use their name and saying, we invested, in some rare instances, actually putting the name in the prospectus, that does a lot for these other investors who are participating, but know they don't have the same level of diligence capability, especially on the scientific side. So that's the reason that crossovers have become so popular. From the issuer's perspective, from your management team perspective, when you're looking at that crossover round, brand does matter. So if an investment bank says, hey, I want you to do a $50 million crossover, and you get 10 people to put 5 million in, and they're friends of yours who are, family offices and or people that don't typically invest in, life science companies, that's not as good as getting 2 or 3 real life science company investors that put $2 to $3, $10 million each into your round. they typically do not want board seats, and they don't want information that isn't going to be cured when the prospectus comes out. So what that means is they will sign an NDA, and you can talk to them about things that currently you're not disclosing to the world, but those things have to come out in the prospectus. Otherwise, they can't ever sell their stock. And since they know they're going to own the stock as public investors, they can't be locked up from selling it once the company goes public beyond the 180-day lockup. That's different than your board members or maybe some of your major strategic partners who are more than happy to be loaded down with, not material non-public information. That's how they make their investment. But what the crossover investors are doing is they're trading the prospect of near-term liquidity for needing as much information as the earlier investors. And I'm pretty sure, I just wanted to check my notes just to see if there was anything else I wanted to bring up on this one. The last thing, there's no formula, but your IPO filing price will be tethered somewhat by what valuation you do your crossover round at. Meaning, if your post-money valuation on your crossover round is $300 million and you're going to go public within 3 to 6 months, unless something amazing happens, like, you got FDA approval or you got some amazing readout of data, you're not going to be able to price your IPO at $600 million, because both the crossover investors who are in already and new investors are going to say, look, if the valuation was 300 million 3 to 6 months ago, how could you have created double that value? So it's not something to fret about, but it is something to be aware of, that in your negotiation with the crossover investors, you have to be aware that that price is going to reflect in your IPO. One final comment on that. I'm very insensitive to what filing ranges are on the covers of prospectuses. Sometimes the lower the filing range, the higher the price. What you're trying to do is create a feeding frenzy in a traditional IPO. Totally different in a SPAC. That's a negotiated price with an already existing benchmark of the trading price of the SPAC. But in an IPO, what you really want is to get so many people excited about buying the stock, to have them, kick into that fear versus greed, the fear that they're not going to get enough stock. So then they become price insensitive pretty quickly. So don't worry that the price of your crossover round will automatically determine the price of your IPO, but there will be a relationship.
Yeah, and I just want to add something because it's germane to what Greg's talking about. I know one of the questions we're going to talk about is the difference between a SPAC and reverse merger, and one of those also is a direct listing versus an IPO. One of the things is in Greg's comment of that crossover round, in a direct listing, basically you've cut out the underwriter and the investment banker to basically fill that book. So when Greg talked earlier about that crossover round and getting that filled, it'd be great if that was nearly full, at least committed dollars before you go out. So one of those things, if you think about a direct listing, ultimately it's those companies that have the swagger, so to speak, to be able to go out on their own without having done that. So, you think about the Spotifys of the world as an example. So just wanted to pause and mention that because I think it's probably a good opportunity to just mention the direct listing. We're not seeing a lot of those in the life sciences space, but just wanted to mention that because every once in a while that comes up.
No, that's great. Thanks, Finley and Greg, for that. So, as we're sort of under kind of this virtual setting, if you will, maybe my next question will go out to Sarah. How have you seen sort of the current environment, doing everything virtually where, obviously traditionally that wasn't the case, impact the process of going, through an IPO?
So preparing for an IPO, I would say is almost always a challenge anyway for private companies. And while we're all adapting, like everyone else, to working in a virtual environment, it's more critical now, I would say, to make sure you start preparing earlier than you would normally. Having that pre-IPO readiness, all the considerations that are needed to go into an IPO, just thinking about that now, even if you're not thinking of an IPO for another, couple of years. Also understanding the risks and key factors affecting, your company is particularly challenging in this environment. Companies should be able to speak to bankers and legal counsel in detail on how the pandemic and related factors are impacting their business and prospects. I'd say I would expect that would be a key area of focus of diligence during this time on how the pandemic's affecting them. And from what I understand, based on recent IPOs, virtual roadshows, it's actually proven to be more effective and efficient, actually, in a virtual environment, and maybe even be here to stay. Definitely reduce the timing of roadshows. And I know the SEC have been extremely responsive and understanding with respect to the pandemic. They've been keeping to all their review timelines, and I would say that IPOs haven't been sort of delayed because of the pandemic. Maybe it just takes a lot more effort from the company in terms of preparing and being ready for an IPO. But if it's specific to the company, I would say it's more about the risks and uncertainties of the future with respect to pandemic. But in terms of the process, I would say I would think it would nothing much has yes changed, but not significantly.
One of the things I was just talking with a CFO client of ours and a longtime friend, he's in this process right now, and he's saying that as part of the roadshow, he can do that and actually reach more people through this pandemic time. And I think
Right.
One of the things that on a personal level that I love is that, I'm not going to have to stomp around in the rain at JP Morgan anymore, at least this year, because it always feels like it's raining cats and dogs, right? But as part of that is as my buddy said, is that truly he's able to achieve a lot more. Now, there are some that still want that face-to-face, and obviously socially distanced and all the appropriate safeguards there. But as part of that is he was mentioning that really he's been able to be much more effective in reaching a broader audience. Now, are the meetings as effective? Because you're not there face-to-face. We'll let all of you make that determination. But again, that is something that's changed here in kind of virtual environment.
Yeah, I'm hearing that that's here to stay, right? Or some of those things are here to stay for sure.
I know, many would like that. Greg doesn't want to commute all the time. And so many of us are in that same spot. Ray's got the easiest commute out to his driveway. So,
and it's always raining cats and dogs and deals and dollars at JP Morgan, but it's something that we all love to hate, right? So don't necessarily miss it all that much. All right, we're doing a quick time check. So we're gonna go through 2 more questions, then we'll open it up to Q&A for the group. So we're going to kind of pivot a little bit. So we talked a lot about the process. What are your different considerations, both internally, external market drivers, thinking about the differences. We've talked a little bit about SPAC, IPO, and really what that's done from a market cycle perspective. So transitioning a little bit, Sarah and Finley, we're going to field this question to you next. What are the key drivers to a biotech stock performance post-IPO, and how do you accurately set a predictable financial guidance given the challenges of timing, regulatory approvals, clinical milestones, et cetera? Finley, I know you talked a little bit about this in terms of the critical components for a company to balance and keep in mind, but anything else that you would illuminate here?
Yeah, I'll give a couple thoughts and then turn it over to Sarah as well. I think, what's interesting, and I do work, about a quarter of my time's in tech. The other 3 quarters is in life science. But when I see the tech, it's all driven off of subscriber counts and, who's buying the latest version of, whatever SaaS-based tool or whatever it might be, right? And those are all great things. But it's interesting that really people are investing based on that subscription model and what it's going to look like in the future. And they're looking at the last 8 quarters and seeing this great ramp and, everything's, hockey shake up and to the right. The investors that are really investing in the biotech space, whether it be device, pharma, et cetera, really looking towards what is going to get that FDA approval. So it comes back to those things of unmet need. Do you have a clinical pipeline? Are you more than a one-trick pony, right? So all of those things. And so that's really the things that investors are focused on. I think Greg said it well earlier in the presentation. But as part of that is that stock performance is, again, keyed to those types of things. So it's not based, revenues don't matter, right, in a pre-commercial company, right? So, okay, well, this collaboration deal, they care who the collaboration partner is, because that lends credence to the technology, right, the platform or whatever it may be. But as part of that is really, from that perspective, it's keyed back to those things that are really driven with why did the investors invest? And so it's a lot different, because in some regards, and Sarah can speak to this from the audit perspective, but what's interesting in some regards is the financials become less important than what's in the rest of the document. And so I think from that perspective, that's a really interesting shift. Sarah, you probably have some comments on that, and companies also sharing kind of financial guidance, certainly in the pandemic. Sarah, thoughts?
Yeah, I would say, in light of the pandemic, many companies are finding it more difficult to predict financial performance. We know what cash is, and it's just assuming, what is my burn rate? And many companies I've seen are withdrawing guidance due to the uncertainty. Accordingly, I'd say companies considering an IPO need to think about what models of future performance would they be comfortable in providing, whether it's news, whether, are they expecting some clinical data out? But it's more, I'd say, qualitative rather than quantitative data that they're sort of providing guidance on, and not really, like you said, Finley, any specific financial information.
Yeah, one of the things on that is that a lot of my clients have pulled financial guidance, like Sarah just mentioned. They also, as we think about, getting phase 2 data, right, and moving into phase 3, or, timing of submission of an IND or NDA, right? All of those things, they're providing a little bit more grace. So instead of a quarter, it may be in half a year, second half of 2021 as an example, versus we're going to hear in July 1st, right? So as part of that is there's a little bit more wiggle room in those things. I shouldn't say wiggle room, but there's a little bit more margin built into some of those things as the market tries to price that out. Certainly, with you think about some of the things, and certainly depending on what the underlying diagnoses you're trying to cover is, and so whether it be looking at enrollment data as an example and saying, okay, well, we've got a very a high risk population, so they're not going to be enrolled in anything, or wherever that's going to be. So as part of that is you think about some of the clinical report out. The critical piece there is making sure that you've given yourself kind of a wide berth, such that you can still meet those expectations or make those timelines that you've really set, and those expectations you've set with the street. So that's really the important piece there that I'm seeing with a lot of our clients is those two things. So pulling the actual financial guidance, and then giving a little broader timeline towards when of these things are going to be done.
That's great. Thanks, Finley and Sarah, for that. So just as a time check, maybe one final question before we open it up to the rest of the panel here, and I'll turn it to Greg for that. So as a company goes through these different phases, prepares for an IPO, in your opinion, Greg, having been through that, how do you advise companies to sort of manage both the change and the communication internally with employees, and also with the management team, the rest of the board, to just make sure that everything is fair and equitable, and make sure that that process is managed successfully as an organization?
So I would say two things. One is everybody comes a little bit from a different philosophical place on this. I always tend towards openness. Some people are sort of like, I got to keep the information here. If it gets out, it could harm, my IPO process, or if, people are working on a strategic partnership and it gets out, it could, cause me problems. I sort of operate under the assumption in the old days that everything was going to show up on the printer. No one's sharing printers anymore, so that's not a problem. But maybe on the company intranet, or somebody's going to by mistake hit, the all of us email, and instead of going to one person, it's going to go everywhere. So I think it's really important to have sort of regular, broad communication. And as long as you're operating from a principle of fairness, so people understand, what's going on and what's expected of them. And one of the things around the IPO will be, budgeting processes, and a lot of information around what people are earning, how much stock they have, different things like that. So if you're sharing overall with the company what's about to happen, and then you have very clear communication on how and why people get compensated and how and why some people may have more or less equity than others. I think for me, that's a pretty good guiding principle. The other thing I'll say on this is I had not been exposed to this before, but at my last company, which was a private medical device company, while I was there, we adopted a system of what's called OKRs, Objectives and Key Results. That's been something that's been championed by John Doerr of Kleiner Perkins fame, and he learned it while he was working inside of Intel. And Andy Grove, the famous CEO there, really brought it to Silicon Valley. And because John Doerr went to Kleiner and they invested in all these great companies, it's kind of proliferated throughout Silicon Valley. If you're not familiar with it, there's a really quick read. It's called Measure What Matters. It's by John Doerr. But it's basically a way to set all the objectives in the organization and to make sure that everybody understands what they are and they filter down to each individual person. So they know on a quarterly basis, what is my objective this quarter and how will I measure it with key results? And then you can hold people accountable. It also does a great job of communicating to your board because again, you're going to go through a change where the board members are your venture guys, and that's good in some ways and bad in others, but they're going to want to, if things are generally going well, they're going to want to generally compensate people. To now you've got public boards who have to follow guidelines, they have to measure things objectively. They can't just give a bonus to everybody because it feels good, because now you have publicly traded shareholders and you have institutional shareholder services. They're going to measure you on all that kind of stuff. So it's just really important. And I think, you know, Finley was talking about this a long time ago. You got to document everything. You know, you've got to have a way for people in the company to communicate that's then documented. So if you start from a principle of fairness and then you put in some systems, and again, I like OKRs. There's a software program called Lattice, which I think does a really good job of measuring it throughout the company. And you can then use those to generate reports, you know, performance reports, and talk to your board of directors about what percentage achievement you've got on your objectives and all that kind of stuff. I think it's important, but it's you're really stepping up sort of your overall accountability, being a public company versus being private.
That's great. Thank you, Greg. Okay, so we're going to turn it over to the group now for questions. Quick time check, we're a little bit over, so we want to be respectful of calendars, but we are thankful for our panelists for attending. Thank you, Finley, Sarah, and Greg. And we are here for questions for a few moments, so we will open it up to the group.